Welcome back, and joining us on the show now is Kunal Shah of Nirmal Bang. Kunal, hi, good to have you. And yet another day where we have seen more declines come in for metals. You know, I was reading various reports where markets do suggest that much of the profit taking or pullback is done. Most of the negative news is now into the prices. Would you agree with that?
I would say partly no, because we have still not seen any meaningful recovery in China and China's real estate sector. So the main reason why, in spite of the supply bottlenecks across the part in Chile, Peru, Mexico, we have not seen any significant rise in prices of a lot of these metals, mainly because of the Chinese demand, which has remained subdued for quite some time. So we've seen at the time of reopening of China, all the metals shot up. And post that, we are seeing a lull phase where the demand growth is not coming. And the main reason for that, even today also, you see most of the Chinese developer property sector stocks in China are down by 4, 5, 6%. So the sector which used to account, we have seen a boom in China's real estate sector from 2001 to 2017-18. That sector is not supporting that major demand side. So the demand growth is very, very muted. Not even 2.5%, 3% demand growth is coming because of the big base also partly. But I am expecting this sector still is sell on rise. Metals are not going to do well in near term. We require more triggers for metals to move from China, especially Chinese demand side, and which seems to be absent for the time being. So till the time we get that kind of triggers from China's real estate sector, metals will continue to remain under pressure, and all the rallies which we are seeing, which we will see, should be used as a good selling opportunity rather than doing any major bargain buy.
You know, Kunal, you're right, because mid-Jan to mid-Feb is when we saw many of those metal prices rise because of the China reopening, and nothing really could hold from those kind of highs. We're down anywhere between 10 to 15% for many of these metal prices. So zinc is at a 26-month lows, and you have the other metals like copper, steel, iron ore, aluminum trading anywhere between 4 to 7-month lows right now. So from here on, as you said, there is some more profit taking that can be anticipated. If you look at the risk and reward ratio on the higher side, how much of a decline versus an upside are you anticipating for many of these?
Okay, so I'm expecting not a big decline from here. I'm expecting conservatively, say, for example, for copper, another 4 to 5% decline. So already we've seen a sharp decline in last 1.5 months. So from here, I would not say that 10, 15% decline or 20% decline from here. 5 to 6% decline would be a good levels to again rebuild positions because of the fact that rate hikes after 2-3 months, we are going to see a pause in rate hikes, and gradually things are going to, so the liquidity tightening, the monetary tightening, the impact of that will nullify 2-3 months down the line, and hence after 4 to 5% correction, we can start resuming, building a buying position. So still another 4 to 5% downside cannot be ruled out.
All right, and those would be accumulating levels, mind you, because we have seen a big pull down already come in case of many of those metals. But Kunal, come to us on the crude oil prices, because 14% down in last 4 weeks, and we are trading below $70 a barrel for the WTI price.
So yeah, so I'll give you an interesting number. So in spite, we've seen before 2 months, OPEC came up with a production cut of 1.4 million barrels. In spite of that, today, crude oil market is in a surplus of 7 lakh to 8 lakh barrels. So almost 1 million barrels of surplus. So I don't see any reason why crude oil should really rally immediately until we see a strong demand coming from China. China was the major trigger for oil to move up, but even the Chinese demand continued to remain sluggish, and we have not seen any strong demand growth from China. Number one reason. Number two, if you look at US oil production, shale oil production is gradually moving up. So from 11.25 million barrels, the US shale oil production is almost at 12.8 million barrels. So the peak was, I think, before COVID, 13.5 million barrels. So we are at the verge of hitting, US oil production is going to hit their all-time high production. So how oil prices are going to move significantly? I don't see any reason why oil should really rally. It should remain under pressure. It has already corrected. Another 5 to 6% decline cannot be ruled out. But the possibility of big uptick is very minuscule right now. So oil is likely to remain under pressure for next 1.5 months at least. And I'm not expecting any meaningful rally in oil for the time being.
All right. Kunal, you're not buying energy, you're not buying metals as well, but are you buying precious metals then?
Precious metals structurally we have been very bullish, and this is a time where they are consolidating. The ETF demand is sluggish, the jewelry demand is sluggish, and hence we are expecting some pullback in prices. But I'm not selling into precious metals. I continue to remain optimistic about the outlook of precious metals, and going forward, conservatively, we can see gold testing again $2,100, silver again can test 26 and $27. So the dip in gold and silver, I am a buyer.
All right. So this is one area where you should be buying structurally a bull market clearly. So gold and silver should be on your portfolio definitely. Kunal, thank you so much for joining us with a sense on all of those commodities. But with that, that's all the time that we have on the show. After the break, Business Lunch will take all the action forward.